We think there really is a very basic idea of the money you need, the money you don't need that is really multi-generational, and then the money that you can take entrepreneurial risks with. And we think the first question is to be very clear about those balances, because especially if it's first generation wealth, the basic principle is you don't want to go back to where you potentially came from. You want to be always in a position of strength and never on a back foot because of whatever happens, whether it's personal or markets, nationalization, sort of elections, politics, or any other type of risk. So we think that's really important. And one of the things I find, and we find when we think of people we talk to, then oftentimes or it can happen when one speaks with entrepreneurs, that they overestimate, frankly, the skill, and they underestimate the luck that it took to achieve what they have. And so I think that is something really quite profound that one has to think about. But if you think about then what the purpose of this asset allocation is, we think of reserve assets, we think of income generative assets, and we think of then capital growth assets with different type of risks. The reserve assets, from our perspective, are there to maintain the ability to operate. So the reserve assets are basically to preserve, to keep the ability to keep on operating. And in the Stern family's specific example, that was the money they had in the States, which was in part invested, but it was what enabled them to keep paying for what they had to do and to have a base with which they could then rebuild from the total loss of their assets that took place. And the bank was destroyed after the Second World War. They didn't get it back. It's a bank, right? It had to be rebuilt. Financial service institutions do not, there's not a plant that operates, right? It's capital that then is deployed. So that's really important. And we think that's cash, gold, and other very, very, very straightforward things. But it's an absolute amount. It's not a percentage of total wealth. In particular, once that wealth is substantial, which is what we're talking about in terms of the Stern family and what we're, talking about to varying degrees, obviously, in this group. But it really is up to a point, it's a percent, but over a point, it's an absolute amount. Then we believe there ought to be income generative assets, which help to provide the income for the family. Those can be fixed income investments, except that's very hard these days because there's almost no interest rates to be had in hard currencies. But it can be real estate. And we invest in some alternative income type funds that we like. It's the only place where we invest in something that we don't do ourselves. We also, for example, invest in emerging market bonds because we think that's actually a risk worth taking. But having the income that you need is also very, very important because that, again, allows you to take decisions out of strength. But then once you've covered that need, the question is then it's the money you don't need and to take risks with. And those are the assets that are intended to ensure capital growth. And for us, we think that 8 to 10% or more, in some cases much more, is a great return for that. And we have our way, and the family has its way in which it is happy to achieve that because it's comfortable with it. But again, this is where you have the whole range of potential investments that you can do. And for us, then the money to take risks with is then the entrepreneurial activity. It's the private, in our case, it's private direct investments in startups. Jay and I have talked about some of those. And it's a similar type of assets. But getting that balance right between the money you don't need, which is long-term, it's in a trust, it's offshore, it's in a safe location, and the money to keep on taking risks with to generate outsized returns, to make a real difference, if you will, to the overall wealth. That balance is very important.